Hi, everyone. Thank you so much for joining us today for the ArborCrowd Advantage webinar. This deck will also be available after the presentation, and we've curated all of your registration comments to help structure what we'll go through today. Submit any questions you may have during this webinar, and if we don't address it during the Q&A, we'll respond to you directly via email. Today, you'll be hearing from our co-founder and COO, Adam Kaufman, as well as the rest of our team. And before we get into the nitty-gritty of the presentation, it's worth noting that we've participated in roughly $270 million of total capitalization across our 8 deals to date, where we've raised about $25 million in equity and already returned almost $6 million to our investors. We've also been acknowledged as an innovator within the space by various press publications and are a contributing member to the Forbes Real Estate Council. This fall, we will be included in an NYU case study that will actually be part of their MBA program's core curriculum and doing a series of panels at top MBA programs throughout the year.
Thanks, Nicole. My name is Adam Kaufman. I am the co-founder and COO of ArborCrowd. When I first started this company, we had a pretty clear understanding of what type of company we were going to be in this new space. And what we had at the forefront of our mind is what our experience was, and that's the real estate itself. We were going to be a commercial real estate crowdfunding platform that was real estate focused, backed by real estate experienced people. We got started uniquely in that we are positioned amongst the Arbor family of companies. Now, all of these companies are independent companies. However, we share the same leadership and often share elements of the same name within the companies. We are consisted of Arbor Realty Trust, a publicly traded real estate investment trust that's on the New York Stock Exchange, and it is a leading multifamily lender across the country and has lots of recognitions and awards that we'll go into a little bit more detail later on. Arbor Management Acquisitions Company, AMAC, which is a full-service real estate investment and operating firm, our private equity shop that was founded in 2012, and we often partner up and syndicate deals with AMAC in the same transaction. And the concept really was to build ArborCrowd in a way where we saw an opening in the market and a shift that was happening industry-wide. Let me take a step back and talk a little bit about Arbor Realty Trust. Arbor Realty Trust was founded by Ivan Kaufman in 1994 and was taken public in 2004. It is one of the only companies in its sector that survived the downturn in 2008. Also worth mentioning that, since they have experienced a downturn, and they've not only survived, but thrived in multiple market cycles. They're a leading lender. They're licensed by the GSEs, Fannie and Freddie Mac, Fannie Mae and Freddie Mac. And, they do a tremendous amount of loan originations, volume come across each year. We are really able to tap into Arbor's extensive network of, they call it borrowers, we call it sponsors in our industry, to really access the most quality, both partners and actual real estate investment opportunities. AMAC was founded in 2012 by Maurice Kaufman and Ivan Kaufman, and they really invested, they made equity investments and bought up properties primarily in the Northeast and Southeast. They still maintain this pretty much the same strategy today, except they've consolidated a lot of their portfolio to New York City and the boroughs. They still have properties outside of the city, but they're very active. They have about 5,200 units under management and have a total deal capitalization of over $1 billion. Like I said, we often partner up with AMAC in transactions together, where they'll provide a piece of the equity, and we'll provide the crowd will provide a piece of the equity as well. Taking a step backwards, people listening to this webinar are figuring out ways in which he or she can invest in commercial real estate. So traditionally, before crowdfunding, there were 4 different ways that you could really get involved. There was direct ownership, which as you all know and can assume, is a full-time job switch. You are actually going to own and maybe operate real estate as a full-time opportunity or job. You then have structures like private equity funds like AMAC. Again, those have very high barriers to entry. So not only do you have to be in the right place in the right time and know the right people when they're raising the money for their funds and have access to these people, but you also have to have minimum investments of $500,000 often, or even more, $1 million to get in. You have the public REIT market. Arbor Realty Trust is a public REIT. While there's a lot of liquidity offered by the stock market, you're also subject to that volatility. Now, I'll take a step and wrap the two together in that in all of those premises, you're buying into the strategies that the people, the principals of those firms or the CEOs of those companies and their boards are driving as their strategies and what investments they're making. Private REITs, also more of a medium barrier to entry, but again, you have to, have the access and way to get in there. Now, fast forward to 2012, and you have the passage of the Jumpstart Our Business Startups Act, and I'll get on a little bit more about that in the next slide. But there were two models that primarily exist from the introduction of crowdfunding. You have the online REIT model, which basically raises up to $50 million, and again, we'll get into more detail on this later on. But people can actually, pool together funds online that they then go invest in commercial real estate. Very low barrier to entry and can be done entirely online, but there are downsides and upsides that we'll get into a little bit later. We operate under 506C, the Regulation D model, which we call direct investment. We basically identify an opportunity from within our network, a partner within our network. After we've vetted it, it has passed all of our tests. We essentially write the check for that investment opportunity, take on that risk ourselves. So we liked it enough to write that check. We then take all of the offering materials and take weeks and weeks to package them to eventually sell off to the crowd. With this model, we not only offer a great amount of transparency in that the offering details are final when we present them to the crowd, but also any aspect of the deal that we don't sell will fall on us as ownership. So in 2012, something happened. The Jobs Act, the Jumpstart Our Business Startups Act, was passed by Congress and signed into law by then President Barack Obama. What this basically did was removed the prohibition of general solicitation on basically investments that can take place, or to solicit people to investments online. Why did this happen? Really because of technology. Technology for the first time was providing people access to more information and more opportunity. And with that, the commercial real estate crowdfunding space came into existence. We, as real estate companies, were watching this happen and understood that borrowers were coming to us through Arbor Realty Trust every single day, and they had a common problem that they often met. It's how do they close the capital stack with an additional $2, $3, $4, $5 million of equity that they repeatedly needed in deals. They could go to family and friends, which is often hard. Obviously, institutional capital, especially at that minimum, is hard to find and or expensive. And we understood that crowdfunding was the perfect way to fill that equity gap. And with that, we created ArborCrowd's unique model, a model that really leverages the synergies of the Arbor family of companies and taps into one of the strongest commercial real estate networks and opportunities that exist in the country.
Thanks, Adam. Alan here. I'm going to talk about the two main regulations utilized in real estate crowdfunding, and Adam has already touched upon them. I'll get into a little bit more detail. Those two models are the Regulation A+ and Rule 506C of Regulation D. And each method really lends itself to a different type of offering. And I'll briefly explain the hallmarks of these two models. So you have Regulation A, which has two tiers, and Tier 2 is the most commonly used method in crowdfunding, which allows for up to $50 million to be raised in a 12-month period. And it can be used to raise money from both accredited and non-accredited investors. And I'll quickly explain for those who don't know what an accredited investor is. So at a very high level, it's an individual who earn $200,000 in each of the past 2 years or $300,000 jointly with a spouse, and they reasonably expect to make the same in the current year, or maybe they have a net worth of $1 million either individually or even with their spouse, and this does not include their primary residence. Reg A, as it's known, it allows for general solicitation, such as using the internet or advertising, and it has very specific filing requirements with the SEC. It's almost like a mini IPO, which can be pretty time-intensive and also pretty costly. And this became effective in its current format in June of 2015. Then you have Rule 506C. Rule 506C has no cap on how much you can raise, but it is only available to accredited investors. And it does allow for general solicitation, but again, with that caveat, only for accredited investors. There's no specific filing requirements with the SEC other than a Form D, which is a really pretty simple form that you file just to let the SEC know that you are going to conduct an offering. And the nuances of the changes to 506C became effective in September of 2013. So I've laid out some of the main characteristics of each of these regulations, and now I'll explain how they're actually used. So Regulation A, which I've explained the basics about it, right? So this method, this is the one that's most commonly used for these online REITs that you may have seen. And it lends itself to raising large funds of $50 million at a time. And importantly, these large funds, they don't actually own any assets when they're seeking to raise money from crowd investors, since the money that they actually are raising is the money they'll actually need to buy the underlying properties. So if they don't have properties, what do they have? Well, really all they're doing is selling you a strategy. And they're hoping that you'll blindly buy into the strategy and basically rely on them to properly execute. I'll give you an example. There may be a company that says that they're going to focus their fund on office buildings on the East Coast. But when they're going out to actually seek the money, they haven't actually identified which buildings they're going to acquire, which office buildings. And that's important because as an investor, that means you're not being provided with information about specific underlying real estate assets, right? It also means that they can't possibly predict what the fund's returns are going to be or the fees that they'll charge. It's not really possible if they don't actually know what it is they're going to buy. Also, I mentioned that these Reg A investments can be for non-accredited investors. So interestingly, the people who probably most need the most information and the most hand-holding are actually the ones that get the least information. Contrast that with Rule 506C, and this is the model that ArborCrowd uses to conduct its offerings. So 506C lends itself to one deal at a time. It actually allows us to identify a specific property that we're going to invest in. There's no speculation for our investors, what asset are you going to buy? We tell you exactly what it is that we're investing in. And we have a very thorough underwriting process, which in this process, we can actually project the deal returns and we can tell you what the fees will be. And that's really important. Because also we've identified the specific properties, we get to put together very, very extensive offering documents and offering packages. Adam touched on this also, and you'll hear a little bit more about this later. But these documents are extensive and they really lay out some of the benefits and also some of the risks, so that you, the investor, can make an educated decision whether this is the right deal for you. And in fact, something unique to us, we're so comfortable with our deals that an ArborCrowd affiliate actually pre-funds the equity investment before we offer it to the crowd on our website. And that's really important. And that's because that means that if ultimately we're not successful in selling the deal and in getting our crowd investors to invest, that means that we're actually going to remain in the deal. And that's an incentive for us to make sure that we only invest in the deal that we really like.
So I talked about it earlier, when I discussed what our mission was, what our goal was when we started ArborCrowd. Our goal was to maintain our focus on the end product and do what we do best, and that is real estate. Not to get caught up on the frills or the things happening around it. And if we stay true to the real estate and our underwriting and our expertise, ultimately, that's what's going to bring people, investors, interest back over and over again. So we also feel that, some of the frills that have been created in this industry relies on technology and algorithms, which, I can't even tell you how many times, countless times, really, I get emails or notifications about, automation services and AI and algorithms that have been built to really surface the best type of real estate investments, and remove a lot of the human intelligence. I can say confidently and accurately, anyone who has a lot of experience in commercial real estate knows that human touch is essential. There is no machine that can replace a human touch and feel for an investment and actually doing the right analysis for it. The advent of this industry of crowdfunding came about because technology provided people access. That's what technology is doing in this industry. It is a conduit. It is servicing investors to access the real estate and the wealth of information around it, and also actually make that investment online. You cannot have it replace the actual fundamental product at the end of the road, and that's real estate. And that's where we feel that we stay true to what we do, and that is actually the commercial real estate at the end of the day. So we have a pretty simple saying: invest in what's real. We screen through our network, through Arbor Realty Trust, the thousands and thousands of borrowers that they deal with. We screened over 500 deals last year alone. We've only actually written checks or equity checks for 9 of those deals, 8 of which have already been syndicated on the platform to the crowd successfully. One has actually come full cycle already, another one on the way. And we're about to launch our 9th deal on the platform coming up, which is a little bit of a teaser we'll get into a little bit later. But of that, we are very selective. Like Alan said, we write these equity checks up front. We like the deals. We have to put our money on the line. Therefore, it has to hit all of our benchmarks in the underwriting process and the analysis that we do.
So all of that analysis is actually represented in the materials that are presented to our potential investors. You've heard Adam and Alan both say that it takes weeks for us to pull this documentation together, and it's in the form of an executive summary, offering overviews, clarity on fees. You have direct access to us as you're reviewing these materials to ask questions. And as well, we'll host webinars not unlike this one for the upcoming deal that Adam referenced and any other deals that come in the future. All of that is so we can make sure that all of our investors are truly empowered to, 1, do their own due diligence, and 2, make decisions that are right for them.
I think, Nicole, to add on to what you're saying is, we're not investment advisors. We don't have an affiliate broker-dealer. What we do is we present the facts and the information for investors to make educated decisions, investment decisions on their own. And that's a really important nuance for us. As we market the materials, we basically present the information that we use to decide to invest.
And then we're there to help you throughout the process.
Chris here to talk a little bit about the deals that we do target. Multifamily investments is the Arbor family of companies' bread and butter, really, and it's really where the expertise lies within the firm. Multifamily tends to be a stable asset class throughout up and down market cycles, and this is predicated on the idea that people will always need a place to live. We target equity positions since you're able to participate in the upside of the value of the property and value creation. And you're also owning a piece of the asset itself. Typically, from a strategy standpoint, value add is the key bread and butter here. You're able to come into a property, do some renovations, increase the profile of the property itself, therefore raise rents and increase the value of the property. This allows down the road for a refinance with additional debt, or selling it at a premium and higher value, creating returns for investors. Typically, workforce housing and Class B type properties are what we target. These tend to be a little bit more resilient during down cycles in the market as people look for reasonably priced units near employment centers. I think an interesting point here is we don't focus on any one area of the country. We leverage the expertise of the Arbor family of companies wherever the best deals are and where returns are for investors. As mentioned before, we've invested in transactions spanning Brooklyn and the Upper East Side in New York to Alabama and South Dakota, showing how we can be nimble and do business anywhere in the country. Talking a little bit about asset management and where we come in. The asset management really starts before a deal even closes. We work with the underwriters before a deal closes to make sure that it makes sense in the real world. We're also here to hold sponsors accountable to ensure that the business plan is being executed from start to finish as anticipated. Of course, no real estate deal goes perfectly to plan, but we're able to work with the sponsors to ensure investors' interests are at the forefront wherever decisions are being made. We're also in constant communication with the team and have our fingers on the pulse of the deal. We ultimately update investors on the progress and digest the wealth of information and relay updates to investors so they can understand where their investments, how their investments are doing and performing.
Just to add on to what Chris is saying, we believe that our relationship with investors starts once the investment begins. We recognize that the hold periods for a lot of the transactions are 3 to 5 years. We're in this together for that period of time. We apply our expertise to manage the asset manages the deals, right? We have regular communication with the sponsor and performance on a property level. We get the information, we digest it, we apply our expertise to it, and then we report that out to investors. So we do that work, and we recognize that that is a partnership and a relationship that really drives the most success, and it begins only after an investment is made.
And that connection is sort of the through line for all of our investors. They're people who want a connection to a real estate institution and sort of the level of trust that it means that they can pick up a phone and call us at any point in the life cycle of a deal with a question or an update, or even when we send regular updates unprompted, right? But it's people from various professions, backgrounds, phases of life. It can be a millennial couple who are starting their portfolio strategy, or someone who wants to invest in us through their self-directed IRA. The baseline is that you must be an accredited investor, as Alan referenced earlier, but it's really a gamut of people who want the connection to a real estate institution.
One of the most interesting things that happened that we never expected when we first started the company was that people who actually work in real estate invest through the Crowd platform. People who don't have the opportunity to invest with the principals of their firms or can recognize the institutional quality of the deals that we present because they're in the industry are a big component of our investors. We never thought that that would be the actual end result that crowdfunding brought about. We know that a lot of retirees would get active, younger millennial couple, people who made money in tech, right? Different asset classes is access. We're seeing a tremendous amount of investors from the actual real estate sector itself, and that's very exciting.
Obviously, when people reach out to us, one of the first questions they ask is, what's your track record? What's your history like? So we'll talk a little bit about a deal that was realized in mid-2018 called Southern States Multifamily Portfolio. The project sponsor was someone that came from the Arbor network and had successfully executed several investments before in these markets in similar strategies, which was basically a value add opportunity for properties that were purchased at steep discounts to market. These markets in Alabama and Mississippi were ones that we really liked due to their great locations near major employment centers. And the plan really included creating operational efficiencies by close management of the properties, as well as physical enhancements to the units and exteriors. And because of the local market expertise the sponsor had, along with the team in place, they were able to increase the value and sell faster than originally expected. The business plan in just 15 months, which is about half the time that was originally expected from start to finish. The sponsor's decision to sell early was predicated upon their local market expertise and the management of the properties themselves. And the result really is an IRR to investors of over 29%. And obviously, when we see a deal like this, we want to repeat that. So we actually closed another deal with the same sponsor. which brings us to our new deal coming up very soon. The deal sponsor is AMAC, who is, as noted before, part of the Arbor family of companies. It's in North Miami with strong fundamentals for exactly this type of opportunity, which is going to be a ground-up development. It's on one of the last large parcels of land in the area where we have seen a tremendous demand for Class A multifamily housing. And the value here is really being created from the ground up. So stay tuned. We'll offer this deal in the coming weeks. Since deals tend to go fast, since it has it's one of the strongest offerings that we've had. It's going to be available real soon.
So that concludes the bulk of the webinar. And we've been curating questions since you guys started registering for this webinar. So we'll just start punching through about 5 of those before we conclude. And we did see a couple of questions around the success of different kinds of deals, and I think it warrants a broader conversation around our approach or how to weigh commercial versus medical office, multifamily, student housing, because we obviously have an expertise, and that is sort of the crux of this conversation.
Absolutely. I mean, I'll kick off. Front and center, we think multifamily in general is just the bread and butter of the industry. It's our expertise. It's what we've been doing, for decades at this point. And our leadership, we're applying that level of experience. I think one of the common issues today in the crowdfunding space is that a lot of different companies are offering a lot of different products. And you need the right expertise, not only in, the ability to underwrite, but having been exposed to the volume of deal flow to really vet each of these deals and opportunities and sponsors the correct way. And for us, growth is really about focusing on what you know best, because at the end of the day, as crowd investors, you're coming in and there's some level of trust that we are doing our job in vetting the opportunities and applying our institutional background to it.
Yeah, Adam, I'll add to that. I think it's a good question. It is one that we get all the time. Hey, are you doing any other types of asset classes? And I think what's important, it's not specifically that one asset class is necessarily better than another. Like, Chris had said, obviously, multifamily is often more resilient in market downturns. But that being said, it's about who you're investing with and do they truly know that asset class well. And, Arbor, the Arbor family companies, as a company, our expertise is in multifamily. Now, we also do have experience in office and self-storage and other areas. And if the right deal comes across, who knows? But really, like Adam said, you focus on what you know, and that's where your expertise lies, and that's what you want to keep doing for your investors.
And if there is a downturn, multi tends to be the most resilient asset class. So, it's important to really focus that, on something that is deemed more stable than something else, especially when you're bringing in new investors.
Great. So the second question sort of is actually a pretty good dovetail off of that, and it's why should people invest with ArborCrowd versus some of the other competitors in the space?
Listen, I think at the end of the day, you have to go to the platform that you feel most comfortable with. So what's the caveat? I'll caveat and I'll say, when you're on a website and you're being marketed a deal or sold an investment opportunity, however it's being phrased, do you feel like you have the right amount of information being presented to you for you to feel comfortable to make that investment? That is ultimately what's very important. The level of transparency, the level of communication, the access to the sponsor track records and backgrounds, the fundamentals that made up the projections. Are they there? What does the market look like? Is that being presented to you? Or do you have to go digging? Is it hard to find? Is there really not much information there? Those are all the questions that you need to be looking at when you're deciding to make an investment on any platform.
Also, I laid out earlier some of the different methods that can be used to crowdfund, right? Reg A versus 506C, and I don't want to bore all our listeners again by, getting into the details. But the reality is, now know there are different types of models, and each one means something else, right? Are you investing in an actual deal, or are you investing in a strategy? Do the diligence. Don't just take the fancy, splashy marketing that you're going to come across. really put in the elbow grease that's necessary and educate yourself and make sure, is this a platform I'm comfortable with? Is this something that they're comfortable with? And that's how you should make some decisions.
And pick up the phone. If the, call in and are your questions being answered? Who are you speaking to? Those are important things, because at the end of the day, you really want to be speaking to real estate experts, people who know real estate. And do you feel like, you have that confirmation? Now, we also don't want to be, daunting here and say that you need to become a real estate expert, to make your investments. The whole concept of the materials is, are they there? Are they real? Are your partners real? Do you believe in the expertise and the experience behind it? Those are important fundamentals to remember.
I think, Adam, one last point maybe to add is what I think is compelling, and I think some of our investors really find compelling, is that we actually pre-fund these deals. We're already in it by the time you see the materials. So we've already gone through most of the work that needs to be done, and then it gets put out to the crowd to invest. Now, obviously, if something doesn't work out, we're holding a piece of the equity. We're the ones that have to deal with it. So we got to make sure that we're actually loving the deals that we're getting into.
Big differentiator. So a much more tactical question next is, can I use a self-directed IRA?
Sure, I can answer that. So yes, the simple answer is yes. You can use a self-directed IRA, and in fact, we on every deal we've done, we've had multiple investors who have utilized self-directed IRAs. We work with various different companies. I'm not going to necessarily list them out, but some of the major companies that people are used to seeing, we've worked with, have good relationships with them. And quite frankly, if anybody is thinking about using a self-directed IRA, pick up the phone, send us an email, and we're happy to put you in touch with those, relationships. And it's definitely something that we see all the time.
And it's part of a larger piece of our investment process, right?
Yeah, and I should mention, we actually, we have people who invest individually. We have people who invest, jointly with a spouse. We have people that have an LLC set up. So we're really geared to accommodate different types of investments, and every situation is unique, and we try to always make it work, and we try to really be there to hold people's hands and help them through the process.
So as we're holding people's hands through the process, it's probably a good place for us to end with an overview of what that process actually looks like, right? We do get that question quite a bit.
Sure, and that's a good question. How do I actually go through this process? So
how long does it take?
Yeah, how long does it take? Exactly. So the process is we think, really pretty simple. Ultimately, you would register for a free account with ArborCrowd. And when you log in, you can see any current offerings that we have. Like Chris said, there's one coming very soon, so it's a great time to register. You can also view all the prior deals. You can click into those deals. You can see the types of deals we've done in the past. You can pull up some of the offering materials that we've put out on our prior deals. And that's actually something a lot of investors or I should say future investors do. They try to learn about us before there's a live deal so that they're ready with their questions and understanding when a deal is launched. So say you've registered, there's a current deal, and you're interested. You would click to make an offer on the platform, and you'll be moved into our transaction center, where ultimately you can electronically sign the documentation. You can go through the accredited verification process, which again is all done seamlessly online.
You could also print all of this out. You get to call us. We'll walk you through it. I know we have people who have different varying degrees of their ability to interact and enjoy the technology component of this.
That's a great point. We have some, we have the millennials who are quick to quickly sign everything online. We also have some people who feel much more comfortable actually printing, signing, and mailing it in, and both really work well. And we have someone who's dedicated simply to the process, and that's what they do. They're available. You can call them, you can email them. They'll walk you through the process. They will try to. It is really a simple process, but for some people, they need that extra little bit of helping hand, and that's what we can provide for you. And once you've actually, signed the documents, you've funded, and the deal is closed, you'll then have an online portal where you can go and actually monitor the transaction, where your Quarterly reports will be uploaded where you can send us an email if you have any questions, where you can get your annual tax documents, your K-1, and really see all the distributions that have come to you. And that's where you would monitor the progress of the deal. And again, we're always there to answer any questions you have and walk you through the process.
I know we've had some people who can get through the entire process in under 30 minutes. Other people like to do it in stages as they're ready and it's available. So, the time allotment is also up to you. And like Alan said, we're here to help.
So with that, we'd like to thank everyone for joining today's webinar. As I mentioned earlier, we will be sharing this presentation shortly after this webinar is concluded. But that said, please feel free to reach out to us at any time, and we'll get back to you via email. And again, all of the questions that we didn't answer as part of that Q&A session will be responded to via email. Also, be on the lookout for news about our upcoming deal. It'll be launching before the end of the month, so stay tuned. They tend to fill fast. We look forward to being in touch.